Welcome to another week of the episode. Wow. Welcome to our episode. Welcome to another week of the Educated Homebuyer Live, where Josh and myself answer your mortgage and real estate questions to help you guys become the educated homebuyers. Educated homebuyer? What is the name of our podcast, Josh? I've completely lost
The
my train.
educated home buyer.
That's what we're trying to create here, guys. Welcome to another week. So, not a lot's happened on the data front since last week this time. Most of the data that we're going to get is actually going to come tomorrow and Friday. So we've seen the market just kind of bounce along. Not really a lot happening out there. Rates not improving. And with that, Josh, welcome. What do you have to say for yourself?
It's Groundhog Day, brother. It's Groundhog Day, but it's good. It's spring buying season, a muted spring buying season, as you all see from mortgage applications, sales volume. We were all hoping, Jeb, in our forecast, what did we think? We were hoping maybe 4.5 million sales this year, and instead we're slightly below last year's anemic pace. So it is still the busy time of the year, not necessarily as busy as it would be in a normal year, but it's an interesting market. What do we talk about every day? It's an interesting market. Something strange and unusual happens to one or both of us nearly every day.
Yeah, and as someone's got two listings right now that are in escrow, there's still competition out there. Things are still selling above the asking price when things are priced correctly. But there's some changes happening out there in the housing market. I can see them. I'm experiencing them. In fact, Josh and I are going to talk about it in more detail on next week's podcast that we record. But today we actually recorded. Josh, what did we record today? We talked about
employment and income. All of these good folks' questions about employment and income are answered in one 30-minute capsule. Every question you could ever have.
Absolutely. And so that actually drops next Tuesday on the Educated Homebuyer podcast. If you haven't checked out the YouTube channel, that is right here on YouTube, where many of you guys are watching this now. So go over there and subscribe. But for now, Josh, I think my train of thoughts starting to come together again, and we are going to look at some charts as we always do every single week. And we always start with inventory because inventory tells the story. Right now, we've got inventory growing. Grew about 16,000 listings week over week. Pretty big jump, Josh. Those are numbers that we haven't seen in the last 2-3 years. We haven't seen numbers like that, where we've gotten week over week growth like that. Last week, we had a big week coming out of Easter. This week, we have another big week, without the holiday. So it's going to be interesting. But 543,000 single-family homes unsold on the market. That's up 3% from last week and 31% more than a year ago. Something to note. So Mike Simonson from Altos Research, now Housing Wire, actually says it's normal that inventory climbs in April, but you can see in the inventory chart below, the one you're looking at there, very obvious inflection point in this year's curve that corresponds to the latest rate jumps just a couple of weeks ago. So kind of see rates ticked up. Guess what? Inventory went up as well. And it's not that there's that many more properties coming to the market. There's just less buyer demand out there. So it's allowing inventory to actually grow. But he says inventory rises when rates rise. So his belief is that the trend's not going to shorten, is not going to slow anytime soon. With that, Josh, Orange County inventory sitting at 2276, growing a little bit, not really a lot. Not what we would like to see, hope to see. Here in Huntington Beach, we're actually going the other way. We've got less properties on the market than we've seen in the last year and a half, at least, going back to 129 active listings in all of Huntington. That's single families, condos, townhomes, everything. So just not a lot to choose from. As we said earlier, went from 526 to 543. The peak last year was at 569. So we're still below that peak, but we're headed in the direction that we're going to peak above that level. You guys always ask what's happening in your market, whatever. Josh and I are located here in Southern California, so it's kind of hard to talk about inventory and, demand and all of these things that are happening. So, as I started the show, everything goes back to supply and demand. Follow inventory and you'll have a really good idea of what's happening in the market that you're in. These numbers, what's important here, look at the year over year numbers more so than anything. And then the 2019 numbers, comparing it back to pre-pandemic. Most of these, as you will see, you might have some year over year growth, But then when you compare it to 2019, we're still under those levels. So we still haven't gotten back to quote unquote normal. Then you look at a market like Jacksonville. Jacksonville, we pointed out, a couple of weeks ago when we looked at these numbers. Jacksonville has not only 53% or so year over year, but up 13%. Is that what that says? 11%? I can't read it from here. Back to 2019 levels. So inventory is growing. But a lot of those markets, Josh, the Northeast, where people are like, it's crazy up here. There's no inventory. Things are still going crazy. If you follow this chart and you look at those cities that are in the Northeast, you see exactly what they're talking about. And it always goes back again, supply and demand. When you have less supply, then you have the number of people looking for homes in this case. It's going to be competitive and things are going to continue to essentially do what they've been doing the last couple of years. New listings, 69,000 new listings this week. That's 3% more than last week and 14% more new sellers than a year ago. So really, really important. And then we take that same chart that we just looked at and we look at new listings in these markets. So kind of going back through similar markets that we just showed, year over year growth, and then versus 2019. So in most of those markets, it looks pretty similar to what we're talking about. And then again, you take into account, markets like Jacksonville, up year over year, up over 2019 levels. So Florida, Louisiana, Texas, these areas in that the southern belt there are starting to see inventory get a little bit more normal compared to the last couple of years. And now we have median price of new contracts. So median price of the homes newly in contract is sitting at $398,000. That surpasses the previous all-time high from May of 2022 of $395,000. The measure of home prices, is 6% higher than a year ago. Yep.
There's a guy here on the YouTube that makes videos that he says the median price is 20% lower year over year. Are you lying? Is it Housing Wire lying with this data? Or would someone else possibly be lying with the numbers they keep putting up?
I don't know. How would they be lying if they're putting data up, Josh?
Well, you gotta call the good thing about the Google machine is you can check our facts, you can check anyone else's facts, and facts are facts. You cannot dispute them. Median price is a limited metric, which we've talked about before. As prices go up, as affordability goes down, it is natural that people would gravitate to lower price points because they're stretching to remain qualified. Yep. On the new construction, which is where that data actually comes from, the median price of new homes, builders can adjust to the market by building cheaper homes, smaller, less upgrades. Buyers themselves can opt for less upgraded homes and end up with lower median sale prices. So consider all of your information and do your own research. If you see something that sounds crazy and unbelievable, it's probably unbelievable.
Well, let's go a little step further. So we're talking about new contracts on that one. Let's talk about the median price of all homes on the market is sitting at $449,000, and that ticked up a fraction this week and is only 1% more than a year ago. So again, we're not talking declines here. We're talking things moving upward. All right. So we've got we missed one there, didn't we?
And that doesn't mean, again, Jeb, that doesn't mean things are on fire. It means we're just kind of muddling along here through the middle.
And then weekly new contracts pending, 71,000 new contracts for single family homes this week. That's up 3% more than a week ago and 7% more than a year ago. Total homes in contract is 385,000, which is actually up 5% more than a year ago. So you've got more homes under contract now than you did a year ago, with rates even higher. But what you're starting to see is buyer demand starting to back off a little bit. Affordability rates are higher, and the market is going to continue to slow as long as that stays the case. Percent of properties actually ticked down this week. We're down to 32% versus like 32.4%. So less people actually reducing prices at the moment. And you can kind of see on the chart there that it's starting to flatline. And this actually comes, Josh, we talked about new construction a minute ago. This is from Pulte Homes, which is a new construction builder.
So they're publicly held. So quarterly, they release their earnings. They have a conference call. This came from their conference call. Consistent with favorable conditions in the first quarter, rates were lower, more favorable than they are now. Almost all of our markets displayed pricing dynamics that were stable or improving, which allowed us to raise net pricing in more than half of our communities. They also referred to their ability to buy down rates as a greater competitive advantage. So, Jeb, we actually saw this number here. This is what this looks like. Their capture rate, meaning if you buy a house from Pulte in 2023, when they were doing a lot of buy down, 78% of people would get their loan from the builder's lender. It's up to 84%. It is almost impossible to not get your financing from the builder. We tell you guys every week, hey, if you want a second opinion, if you're looking for a lender, reach out to us. In a normal market, their capture rate is like 15 to 20% because we can kill them 8 days a week. Better service, better figures, better knowledge, better expertise, all of that stuff. But it doesn't make up for $10, $15, $20, $30,000 in buy downs and closing cost credits, which is what they're doing right now. So you guys ask about it a lot. I wanted to throw that in there. A little bit of data here. Everyone always in the comment section of every episode or any episode where we talk about what's causing affordability issues, it's investors. Investors are buying everything. Well, the green markets here tell you where investors are buying now, and pink tells you where they're backing out. So if you look at those markets, what you're going to see, the expensive markets where rents are high, but they're low relative to the high purchase prices, investors are backing away, and they are not a significant impact on those markets. Now, other markets, if you're in Memphis, Atlanta, Birmingham, Indy, a lot of the more affordable markets with lower price points and rents that are they're high relative to the home prices, that's where investors are at right now. So we're going to go full-blown Mythbusters for you guys tonight because we hear lots of crazy things. Again, in the comments section, what do people say? Who can buy houses? No one's making money. This poor generation, these people don't make any money. Wage and salary of workers 25 to 34 years old, entering the workforce and moving into that prime home buying age of the early 30s. They are making more money than they have since the early 2000s. Does that mean everyone is? No, but as a group, as a cohort, they are making more money in terms of the median nominal earnings in many, many years. So the interesting thing to note there, we're going to show here, this one here, Jeb, we hear this all the time. Hey, housing is going to crash because the population isn't growing. The population is growing. So we have immigration besides the birth rate. The birth rate is decreasing, but we have a very large population. So a very low birth rate means that population is growing. But when we have less people of a generation, not growing at the rate that it was, it's kind of like inflation. Once it's up, it's at a level where it sustains itself, even if that rate of inflation drops. But the thing to note here for those 25 to 34, if you're educated and trained, if you're a welder, an electrician, a tradesman, anything that is in demand, there are less of you. It's a smaller generation. So there's the benefit of that. And it could be an explanation for why wages are higher. We hear all the time, Jeb, how many times we see this chart? Oh my God, the consumer is going to crack tomorrow because credit card debt is at an all-time high. Very true and correct. Household debt service payments as a percentage of disposable income at the lowest levels since like 1980. So why is that? Well, there's a couple of reasons for it. We're going to go through them here in a few more charts. But realistically, most people converted a lot of their debt to lower fixed rate debt during the pandemic, paid things down, paid things off. We've been seeing a deleveraging of the consumer since 2008. So this is the natural outcome of it. And does this mean that no one is stressed? No, there are consumers out there that are stressed, but there's a lot of people that are highly unstressed and can afford to purchase a home.
And so Josh, when we talk about the buy now, pay later generation, we're just going to assume that a lot of those people aren't homeowners, correct?
Exactly.
Right. And so they might be leveraged themselves, but when it comes to debt service on their household, so to speak, there's not a mortgage in the equation.
Because what's Jeb saying, this includes mortgages. So when you factor that out of the equation, hey, you might have higher debt, but you don't have that mortgage, so your debt service is low relative to your income. This is part of that reason, Jeb, here, and we're seeing all-time high, 38.5% of homeowners have no mortgage. So when you go back to their debt service, what debt do they have? You and I talked. I drive a 5-year-old truck. Oh, I wish I had a 5-year-old truck. I have a 7-year-old truck, but it's paid for. My wife has a 5-year-old car. It's paid for. Like, I look at my debt service, I go, pretty reasonable. Is the world great? No, the world's not great, but you're in a position that it doesn't really impact you if you're not leveraged and owe a bunch of money on stuff. This, on the other hand, Jeb, I thought this was another interesting look. We talk about our government loving to borrow money. $101,170 per U.S. American person in debt. So that's how much you owe and how much I owe.
My kids owe that too?
Your kids owe that too. Your wife owes it. My wife owes it. I think my dog's excluded, but if you go back and look here as recently as 2020, this is like $25,000. Like, this is absurd and astronomical, and it will have implications in the long haul. And you guys are probably getting tired of me talking about it. So I will move on. This, we haven't talked about in a while, Jeb. This is the spreads between mortgages and the 10-year treasury. I actually did this with Optimal Blue's conforming market mortgage market index. I think it's a little bit better than Freddie Mac's primary mortgage market survey. It doesn't make a big difference to the numbers, but what you can see, it's been improving. So this is sort of a Rorschach test here for you, Jeb, as to whether you are a glass half empty or a glass half full. The half full person goes, look at that green line. It's been coming down. And the glass half empty person goes, look at that red line. That's insane. Both are true. We continue to watch it and hope that we continue to see some normalization, but probably going to just continue to grind lower unless we see a big change in the market. This one, Jeb, what I did here, 10-year treasury, we look at this, but these candlesticks are weekly candlesticks. What I wanted to show you with that, the little tiny green body on the candlestick over to the right, that shows you the beginning and ending of the last 5 trading days. We've gone nowhere. So a lot of noise, a lot of volatility from day to day. You'll say, oh, rates were better today. And oh my God, rates were worse today. And you get to the end of the week, you're like, they went absolutely nowhere. So what does that mean for you if you're in the market? Mortgage News Daily has a 30-year fixed, a little over 7 3/8. Optimal Blue says it's a little over 7 1/8. Probably because Optimal Blue skews more towards direct lenders that are more likely to charge you points with that rate. They're probably quite similar underneath it all. The FHA, 6.87, 6.843. And as always, well-qualified borrowers can do a little bit better than that, but those are pretty accurate numbers of what you'd be looking at out in the market.
All right, good stuff, guys. So if you found any value in that information at all, do us a favor, hit the thumbs up, subscribe to the channel if you haven't done so already. If you haven't checked out the podcast, we would like you to do that. And more importantly, if you'd like to work with Josh, our team here, there's actually a link that I'll put on the screen right now where you can reach out and get in touch with myself and Josh. If you need a mortgage, if you need real estate, we are here to help guide you through that process. So reach out. We would love the opportunity to help. All right, Josh, the people have spoken. They are answering. They're asking questions. Dude, I can't talk. They're asking questions. So let's start with some questions. Willing shows up every week. It might just sit on YouTube while at work, typing in comments. So we're going to start with one of their questions saying, if you have a veteran who qualifies for an exemption of property taxes, can you exclude the property taxes from the DTI? And can you exclude it from doing a conventional or just a VA loan? So I guess maybe start, Josh. What veteran would qualify for some sort of exemption? I think is a better question for everybody to understand. And then how does that factor into qualifications?
In many, if not most states, disabled veterans qualify for a property tax exemption. In Texas, it's 100%. California, significantly less than that. Most of them require 100% permanent and total disability. Some of them will operate off of a lesser disability. But the important part is when we're qualifying you for that loan, when we're trying to get you approved for that loan, we have to estimate what the property taxes are. So in California, you are going to be underwritten with the actual property taxes, despite the fact that you will get an exemption. I actually have a veteran going through this right now. They're buying here in Aliso Viejo, 100% permanent total disability. They're going to get their exemption, which California, I believe it's $100,000 off of your assessed value. But other states are working on passing legislation so that the underwriters are able to exclude or account for that lower rate of property taxes after the exemption. So it depends on where you're at. I think Texas has done that. I believe Maryland has done that. Don't quote me on that. But we, the group that I'm a part of, Vetted VA, the Association of Independent Mortgage Experts, are pushing and lobbying for that for all veterans around the country. But if you're talking about here in California, no, we can't. Most states you cannot, but there are a few states where you can use the exemption during qualifying.
All right, good stuff. Before we dive into another question, we got a couple people just saying hello. Got Say, love for puppies, Maria. All of these people show up every single week and are saying hello. Tim is another one here. What else? Who else do we got, Josh? Anybody I'm missing here that's saying hello? Sparrow Goat. And
Those are two opposite things.
Listen, it's we don't get to choose people's usernames. We just post them and go from there. So that's where we're at. All right. Let's see what we got here. Moneybags is asking, do you see homes appreciating year over year? Yes. In most markets out there, I think you'll see year over year appreciation. As we move towards the fall, I mean, this year, you're pretty much going to see it, I think, year over year for the majority of the year. If things start to slow down in the fall, next year, it could look a little bit different, just depending on what happens to rates. But, it's hard to say at this rate. I mean, I think, I only know what I see in the market, in my market, and I'm seeing homes that are priced correctly, under $2 million, which, the majority of buyers in most markets are under that $2 million threshold. Homes are still selling above the asking price in many cases. And if they're not selling above the asking price, they're selling pretty close to the asking price. And these homes are listed for more than the previous homes in most of the communities previously. So you're going to continue to see that trend continue. It's not likely to change unless we see rates stay high for an extended period of time.
And it is regional, very regional.
Absolutely.
For us in Southern California, very tight, very hot market. Have a buyer right now, viewer of the show in Pennsylvania. They're experiencing a very tight market. Talk to some folks in different markets in Texas, and they're like, no, we think we'll be able to get the seller to cover our closing costs. So it really depends on where you're at. And that is where having a professional realtor in the market, boots on the ground, doing transactions, talking to other agents, dealing with sellers, and knowing where the market is at, knowing and being able to advise you in your market. Because nationally, we can absolutely say that for the next 3, 4, 5, 6 months, we're definitely going to be seeing year-over-year price increases. We get to the fall, we'll see what happens with interest rates, we'll see what happens with the economy. But there are markets where that's not the case.
No, absolutely. Francisco Papa says, I went under contract for a $297,000 home with a $10,000 appraisal gap. Let's just say what that is, right? So that means, hey, I'm willing to pay up to $10,000 towards the appraisal if it doesn't come in, right? The appraisal came in at $267,000, and we sent the seller an addendum saying purchase price to be $277,000. Seller wants $15,000 gap now, which we declined. Can the seller legally back out? So in theory, yes, because even though they signed the appraisal gap, doesn't mean that they have to accept the 277. That's just what you offered at that point. Now they want more, so they can, in theory, do whatever they want. Now you don't have to go along with it. But what I will say is, if it's in California, a seller can't just say no and then cancel the contract. There's still a negotiation there until there's no negotiation, at which point you can't get through the negotiation. Then there's a notice to perform. And if you don't perform, then the seller can legally back out. In other states, I'm not sure how it's structured. But unless they agreed on an actual price, then, the seller's still in control of that situation. And you're kind of at the mercy of drawing your line in the sand and deciding what you want to do.
It would be an interesting question if you're advising the seller, Jeb. We don't know anything about this transaction, but in general, we have an appraisal that came in substantially short. You have someone willing to give you $10,000 more than an appraiser thinks it's worth. You're really going to take it off the market, put it back on the market, try to get another solid buyer that will either get a better appraisal and or pay more of the gap. It's a little bit of a risk, right?
Huge risk, right? I mean, the only time you would do that is if you thought you had enough demand to get a higher price, and or you thought the appraiser used the wrong comparables, and maybe something that's closing that's going to support it. I mean, there's a couple of examples, but in all reality, like the conversation is, hey, we're in a slowing market. Rates are moving a little bit higher. Demand is going to slow. I think this is a reasonable um, offer from the buyer. But again, you don't know the conversation between the buyer and the seller, and I mean the listing agent and the seller, who suggested what price, all of that, and all of that plays into the emotion part of the transaction, which is interesting when they say, hey, AI is going to do my job. Okay, uh, let AI handle like real emotions, because it can't be done. It's hard enough for us to deal with that emotion versus someone else, or a computer that doesn't even understand that piece of the puzzle. Big G says, I've read that California is trying to limit the number of houses investors can buy. I've also read that buyer investors are not driving up home prices. What do you think? So, Josh, here's what I think. I know that at the moment, 3.3% of the transactions happening in the state of California are investors flipping property. 3.3% of the transactions in the entire state. So they are driving up prices to some regard, because they're buying a home for lesser than they're going to sell it for, because many times they're rehabbing these properties, they're redoing them, whatever method they want to use, the Burr method, they just want to fix it and flip it, whatever. They are taking a home off the market that someone could otherwise buy, and they're driving up prices. Now, is 3% of the inventory a problem? I don't know. It depends. If it's the only home in a neighborhood, it could be. But if there's more inventory in one market and they're just buying the distressed homes that nobody else wants,
Well,
then I don't know
Jeb,
that it's a problem.
you said an important thing there, distressed. Okay. So if you have a property that's trashed and requires a cash buyer, are you really taking something away from first-time home buyers or entry-level buyers? They can't buy that.
Well, you could say that, but then you could do a 203. I mean, there are opportunities, right? It's not just black and white. There are some options out there with regards to loan programs that could allow it. Most people wouldn't go that route, but I do agree with you. I'm just playing devil's advocate. And when I say distressed, I don't know that 100% of the properties that they're buying are distressed. I'm just saying investors are buying property, and typically, if they want to buy a property for flipping, it's something that needs work.
I think what you said is important. We're just playing devil's advocate here. If there was some regulation that kept it out of the hands of investors, would that mean more people got more opportunity? Absolutely. Is there some good that comes out of that? Absolutely. But there's a couple of things we need to take into account. There's the rights of the property seller also. Let's say you own a home and something terrible happened and you need money really fast, and the only asset you have is that house, and the only person that can close in a week and hand you cash is an investor, but the state passed a law, and now you end up losing that home or missing an opportunity or not being able to get cousin Larry out of jail. I don't know what the number is.
Larry's in jail.
It's Larry's in jail. It's a slippery slope and dangerous, taking away the rights of any group. So it's easy to say, hey, who cares about investors, especially big corporate investors? I get it. No one cares about them. But you are infringing on the right of that seller also. And many of these situations are not homes that would go to end buyers. So it's a little more complicated than it looks on the surface, but I certainly understand the thought. And for me, Jeb, I'm just tired of California. Stop trying to lead the country and pass legislation like this. We're going to be the most craziest,
we already are,
liberal place in the world, and we'll force our values on the rest of the country. It is not an issue in California. We've gone through this. If you're in Atlanta and you're seeing home buyers struggling because we have big corporate buyers buying thousands of properties, and you want to lead the country with this legislation, I get it. It is not an issue in California because our real estate is too freaking expensive for investors to invest heavily here. So it's virtue signaling by the clowns in Sacramento to say that we are the most wonderful, caring people. We're going to solve problems that don't exist and pressure other states where they may actually have this problem to do something about it.
Agreed. I'm a capitalist. I don't like regulation on things like that. I get hate for that. It's just what it is. And I don't like when government gets involved and starts making rules, because the pendulum always swings too far in one direction and it becomes a bigger issue. And doesn't actually fix the problem most of the time. That's just my 2 cents. So it is what it is. Something needs to be done, but it needs to be thought through, and it needs to come from, it can't just be a California thing. It needs to be something that's, coming from, I don't know. I don't know the right answer, but I just know something. Inventory is a problem, and, you can incentivize things, you can do different things, but all of those things have their own issues that come along with them. With that, Josh, let's transition. Sparrow Goat says he was told that there's a YouTuber buying in cash in Santa Clarita. So here's what I know, Josh. I think there's 9 YouTubers in Huntington Beach. Between those 9, they have a combined 100 million plus follower audience between all 9
That's
of them.
a lot.
It's a lot. I forget what the name of their little group is, but I think there's 9.
There's a cabal of YouTubers here in our city.
Oh yeah. And they all like own them. They own in the Peninsula. They own Edwards Hill. I mean, we're talking big real estate, $3-4 million pieces of real estate. But a couple years back, I was one of my friends, cousin of one of them, said, "Hey, this guy, I'm not going to name him, is going to be buying a property. It's $3 million, and he was a cash buyer." And let's just say the guys that are 16, 20 million person audience, they're doing okay. You don't need to feel bad for those guys. They're doing just fine.
In the original,
me, on the other hand, I am not doing fine. 100,000 subscribers does not buy you a $3 million house in cash, in case you guys were wondering. Just wanted to clear up.
He's begging for super chats right now, so he can go get the $3 million house in Edwards Hill.
Not at all. Just wanted to set the record straight in case people were confused about how this whole thing works. But Love for Puppy says, if you do not choose to escrow, do lenders require a certain amount of reserves? So maybe Josh, talk about what escrow is, and then you can talk the answer to the question.
Before we say what it is, let's look at it this way. Depending on the loan program and how much you're putting down, the lenders can just require you to have it. It's not an option for you. So what is it? It just means your taxes and insurance being included in your monthly payment. So you make one payment, lender's responsible for paying the taxes and the insurance. They prefer this because it ensures that it actually gets done. You can't screw it up. You can't not pay it. You can't can't leave the house uninsured or have a big property tax bill unpaid. So what loans require it? FHA requires it. USDA requires it. VA does not require, but most VA lenders do. Those that don't generally are going to require you to put more than 10% down. The vast majority of VA buyers don't put 10% or more down. Conventional loans, pretty much the same thing. You're going to have to put more than 10% down before the lender gives you the option. So it's either they're going to require you to, or you meet their requirements for having the choice, but it never really comes down to you having additional reserves and therefore having the option.
All right, good stuff. Let's see what we have here. Not a ton of questions, a lot of comments. There are some people, like Joyce came in and just said, "Hey guys, thank you for doing this every week. Appreciate you." We don't ask for a lot, but what I will ask for is if you ever find value in the show, like it, subscribe to the channel, head over to the Educated Home Buyer, do the same thing. But what would really do us a huge favor is that if you listen to the podcast at all, if you go over, if you're on Apple, if you're on Spotify, and if you actually rate it and review it on there, if you could type something about it that you enjoy, whatever it is, could be a 1 sentence. That actually helps us because then it pushes it out to more people. Just like the likes and subscribes here on YouTube kind of finds its audience and it pushes it out to more people just like you guys. When you do that, that helps. And again, we don't ask for a lot here. It's our time, but that would be very helpful if you guys ever feel like you've gotten value from the show, whatever, head over there and help us out. We would be very grateful for that.
Jeb,
ZL,
hold on. We have an important one before that. Oh, okay. Tim wants to support the show by buying merch like the shirt Jeb is wearing.
I had a store for a while. No one was buying them. So here's what I'll do for you, Tim. Email me your address, the size shirt you wear, and I'll send you one. How's that? That easy. You don't have to buy anything. But with that, head over and rate us and review us. How's that? I lost the question that I was going to go to, Josh, because of we took it off. Oh, here it goes. ZL says huge increases in property taxes and insurance for new homeowners. What are your thoughts on if this caps appreciation in the next few years? Thoughts on that, Josh? Does it cap?
Anything that hurts affordability, like what did we see during the pandemic? Rates dropped really quickly. spike in affordability, so home prices went up. Does it follow that the opposite, something impinging on affordability, rates going up? We saw that it has rapidly decreased the pace of inflation. It stopped home price inflation. It stopped it for a while, but it's definitely kept it lower than it was. So would other additional costs, higher homeowners insurance, higher property taxes, would they put the crimp on that? You would think so, but I think the property tax piece is a bigger problem for home owners. So you bought for $300,000 and had no idea that in 5 years you were going to wake up in your house with maybe $600,000. Your property tax is double. You weren't counting on that. You didn't qualify for that. That could be a problem for you. Same thing with the insurance. For people coming in right now, they're expecting it. They know what they're walking into. I think it's a bigger problem for homeowners. So then the question then becomes, do some people go, hey, I wanted to become a homeowner, but this just doesn't work? I think you see a little more of that, but will it have an impact? Will it be a break on home price appreciation going forward? I would think that it would be. I don't think it's going to be something huge that completely changes the trajectory of the market, but it should slow growth going forward.
Agreed. Let's see here. Comment from Burn It Up just says, thanks for the updates. Thanks for snapping me out of the crash mindset in 21. No way I would afford in the high desert in California today. So yeah, you did it. We didn't talk you into it. We just gave you the facts and you decided to buy, and good for you. Congrats. I know you're here every week and you continue to support the show, even as a homeowner. You often comment on a lot of my videos too, outside of this. And so thank you for continuing to support. Love for Puppies, $5 super chat. So thank you for that. Just wanted to say thank you and thank you back. We are grateful for that. Question from Dina. Dina is a regular here. Just says, do you think the squatter situation will affect the housing market? There's always been squatters, right? Back when I did a ton of foreclosures in 2010, 2011, 2009, I guess through 2011, some of them were squatters because the property was owned by somebody else. They were charging rent. Property got foreclosed upon. Renter said, I'm not leaving. I'm staying here. So it's always been an issue. I think as affordability continues to creep up on rentals and everything else, squatting, it's never going away. You're always going to have it. Is it going to become a bigger problem? I don't know. Maybe in some markets. The problem with states like California is that these people have rights. How? I have no idea. Tell me how somebody taking over your house and just making their way in and decides not to pay now has rights. But that's where we live, Josh. You made a comment earlier. That's where we live. These people now have some sort of say. But in most states, not an issue. States where there's little to be done and there's protection for these people, you might see it happen more often. Is it going to affect the market overall? I don't think so. I think it'll be localized. It'll be where there's bigger populations of homelessness and affordability issues, and it'll be what it is. And it's not going anywhere.
It would be really interesting, Jeb. The big feature, part of the reason why prices dropped so badly in 2008, 2009, 2010 is the banks took those properties back, got the people out. And so there was mass quantities of empty homes. In today's day and age, with the popularity and the social media presence of this idea of squatting, I hate to think what would happen with all of those vacant homes and people reading up on the laws of how, hey, I can go occupy that thing, and in 30 days I've got tenants' rights, and I show up and Fannie Mae gave me a lease. It would be interesting. Hopefully we never see it again.
No. There's some YouTube videos out there, TikToks and stuff, where people take over these properties, and it's interesting. How's that? ZL follows up and says, why do YouTubers keep defending investors, corporations buying up homes? What are the positives in letting them buy up whatever they want? So I'll take you back to 2010, 2011, a market that had been depreciating rapidly through the pandemic, through the housing bubble, the Great Recession, if you will, of 2008. There was a mass supply of homes on the market, way more supply than you had buyer demand. It was a true buyer's market. Prices got just murdered during that time. Well, guess who came to the rescue for the housing market at that time? It was investors. It was corporations. They were buying up these properties. Some were buying them to fix them and keep them and rent them out. Some were buying them to fix them and flip them, aka Josh. There were different things happening in the market that you could say, well, if that would have never happened, prices wouldn't be here today. That's fair to say, but the reality is something had to happen back then because of, housing makes up such a large sector of the economy. You need housing to come back in order for the economy to kind of catch back on and grow again, and that's essentially what we've been seeing this whole time. So I'm not defending investors per se, but I just don't like government intervention in things because I think it creates additional issues. So you can say I'm for it, you can say whatever, but that's the reality.
What you said there, Jeb, unintended consequences. Politicians never know what they're doing in terms of writing this and say, hey, there's this thing that's bad. Let's write up this legislation to make it not happen. And right now, I don't think it would get almost any pushback. If we put it on a ballot and said, hey, you guys in favor of large scale investors not being able to buy real estate, it would pass pretty easily.
Yeah, large scale, I agree with 100%.
Okay, so, but again, what did we need in 2009, 2010?
No,
we needed people, corporations that could come in and could buy 100, 1,000, 2,000 homes at a time that were distressed, that were going to hell, that were bringing the other values of the homeowners' homes. So you see what I'm saying? It's not a matter of defending them. I don't know that anyone can really do the role. There's no needed role for them in the current marketplace. Going forward, we may have a point where we need them again. And you can't say, hey, you guys weren't needed. Go sit on the sidelines. We'll let you know when you can come back in. God damn these lights, Jeb. I'm going to lose my mind here. But you know what I'm saying? You just can't be passing laws when because things do change. We won't always be in this market, despite the fact that, you and I have gone through these numbers and you always have to be very careful saying, I don't see anything that could change this. But we go through the data, we look at it. What are the things that could happen that would change the trajectory, make more supply available out through the end of this decade? Which the crazy thing is 5-6 years left in the decade. It's not a long time. I don't see much that can change it. When we get into the next decade, we do have boomers start, retiring and dying at scale. That changes some things. There's definitely things that can change. You don't know what the future brings 5, 10, 15 years down the line. And you can't just pass laws because we don't like it today without being very, very cognizant of unintended consequences.
You don't know what you don't know. Jeff, basically just another comment, says, been watching you guys since I purchased last April, still watching to just stay informed on these interesting times in the market. Thanks for all the info and insight. You're welcome, Jeff. Appreciate you being here and continuing to support the show. This isn't one of those where we just continue to put everybody's great comment on, but I'm going to do it to some degree because, because
this is the flip side of yesterday, Jeb, the comment section. So this is we got the negative fire and vitriol from the people with the sub 60 IQs, and you smart people are showing up today. And giving
I think the reason, I post this more so than anything else, just says, been watching you ever since I purchased in 2021. So guys, it's 2024. That's 3 years. 3 years we've been doing this sort of thing to provide you guys insight into what's happening in the market. And, fortunately, for most people here, they've been able to, get something out of it. We brought value and they've been able to capitalize from it. So congrats. And again, thanks for continuing to show up and support the show. This comment came in earlier. I want to post it on here because this is part of the problem with buyers in the market now. The comment says, millennial here, I've accepted the fact I will never be able to afford a home. So Josh, when you hear that, what do you think? Other than just a pessimistic mindset.
So we just talked in terms of totally different topic. We don't know what the next 5 years brings. We don't know what the next 10 years brings in terms of supply of homes, affordability. Maybe rates drop to 2% again, and we're in a terrible economy and no one wants homes. As hard as it is to believe, in 2010, I could not talk people into buying homes that their monthly payment would be less than their rent. And you're like, nope, that's a lie. That never happened. Not only did it not happen, it happened every day that I would be telling people, hey, you should buy a house. You're paying $2,200 in rent and you can own that house for $2,000. So things change. Your life changes. You don't know what that looks like. If you're single, you don't know what a dual income household looks like. You have this whole thing, dual income, no kids. A lot of people choosing not to have kids. You have two incomes and a kid. Maybe life takes you from Southern California where prices are absurd and you get a great job offer in my favorite, Omaha, Nebraska. And you look and you go, it's a pretty rad house for $275,000. So location can change, relationship can change, job can change, anything can change. So people get super frustrated when you say things like, whether you think you can or you think you can't, you're right. But if you just say, I failed, I'm going to curl up in a ball when I got 50 years left to live, it's not helpful to you when a million things can and will change. Like if I think back, I had a path, like I'm a planner, Jeb. When I was 21, here's the path, here's how it's going to go. Didn't go anything like that. Good things, bad things, just different stuff happens. You don't know what's going to
And I'm exactly the opposite. I have no plan and things still work out the same way they're supposed to work out. I believe things happen for a reason. You're going to end up where you're supposed to end up. And, you know, again, all you can do is continue to educate yourself and put yourself in the best position possible so that if an opportunity does present itself, you can capitalize on it. You know, it's really that simple. You can choose to be woe is me, pity party all the time. Hey, I'm never going to be able to do this. Or you can go do something about it. And I believe that most people should try to do something about it. Josh, we've got, let's see here.
Yep.
Flight Simulation Experience says, would you guys agree that today has never been a better time to be a renter? And if this situation stays the same for decades, then it might be best to just be a lifelong renter. So Josh, do you believe right now it's better to be a renter?
No. If I
Why
did,
not?
I would sell and rent because my mortgage payment.
Well, okay. I understand your perspective. You're a homeowner. Your mortgage payment's low. Let's take the other side. You're a potential buyer.
Well, it's not magic.
Okay.
Once upon a time, I wasn't a homeowner.
Fair
Let's
enough.
just say if I had not bought my home in 2003, that home that I could have rented at that time for about $2,800, I could have been like, what do I want a $3,800 house payment for when I can own this or rent this house for $2,800? Well, because of inflation. We hear every week, inflation is terrible. Inflation sucks. A renter is never in control of that. So if we're saying if the situation stays the same for decades, we're underbuilt, undersupplied, not enough rentals, landlords have all the power, they're raising rents 4 or 5% a year above the rate of inflation. Yep. Do some math, grab the calculator and tell me how far into the future it's a great time to be a renter. Not very long. The renter is not paying down principal. They don't have a fixed payment. That payment is going to go up. They don't have the opportunity to refinance if and when rates go lower and lower their monthly payment. So you are subject to the whims of the universe. And probably the most important thing, Jeb, I would like to say, you are probably not the 1 in 10, 15 out of 100 engineer, highly disciplined, great at saving and investing. Graham Stephan did this video. Smart dude, real estate background. You can't sit and argue with what he's saying, but he made this argument. You may have actually watched that video, and that's where this question comes from. He makes that argument for us in Southern California when you can rent a house for $4,500, that it would be $8,000 to own. That's a bitter pill to swallow. It may not be reality, but when you flash forward, not 20 years, 7 years, 8 years, 9 years into the future, where the question was, if things stay the same, that renter is going to be in trouble and very unhappy about not taking the power into their own hands. So from a cash flow basis, in the short run, is it better? Absolutely. There's no comparison. And in kind of big picture, if you don't have pretty strong stability and committed to being in one location and happy being in that home for the long haul, you don't really have a choice. It doesn't make sense to jump in arbitrarily over a short timeline, but I don't buy into this that renting is like a no-brainer because most people spend the extra money they have. They don't save and invest it.
Fair enough. And here's what I'll add to that, just so we can get into another question. I sell homes for a living, right? So I meet with a lot of sellers. Never have I met with a seller that says, God, I really wish I wouldn't have bought this home. I wish I would have rented instead of owning this piece of property. More often, the question is, I wish I would have bought 10 of these. I wish I wouldn't have missed out on so many of the other properties that I wanted. So again, the dynamic's not going to change. It sucks right now because it just looks so bad with affordability. Affordability will improve. Things will normalize. But the reality is long-term home prices are going to continue to appreciate. And so you can be on whichever side you want to be on. The show isn't to push you to become it. The show is to help you become educated so that if you want to do it, you can do it. That. All right, Josh. Let's see. What do you got?
Well, here we have a
Yep.
follow-up. He says, did you meet any sellers who said, wish I didn't buy a home in 2008? No, because in 2008, we had already seen the crash. Anyone that bought in 2008 was ecstatic to say they did it. So 2005, 2006, 2007, this is funny. We got the same line of reasoning in yesterday's videos when we're explaining why the market's not going to crash. I wrote a white paper in 2006 with an investment advisory firm saying, hey, homes are overvalued. We have zero down payment. We're doing loans for 580 credit score borrowers with arms fixed for a period, most of them 2 to 3 years, and they're going to adjust. This is a recipe for disaster. Did people get themselves out over their skis? Yes, they did. And you can go through and say, hey, this was a terrible thing that happened to this person. But most of the people that lost their home got in very late, put very little down, and what they lost was their credit. I'm not saying there's no one who made a down payment, worked hard, saved, put that down, and then ended up losing their home with an FHA loan that they qualified for and had decent credit. But when you look at that, it's this myth. And again, we get people that are younger, 30, 35 years old. And back then they were 16, 18, 20, had no idea about owning a home and what goes into it, the thought process. And they think that, hey, I watched The Big Short. There was mortgage brokers on the corner clubbing people over the head and making them buy houses. No, I had buyers that literally would buy a home in 2000. They come back the next year. Hey, I need to do a cash out refi. Come back 2 years later, went up. Hey, I need to do a cash out refi. By the third one, hey, I don't qualify for this, but you can do stated income, right? Cool. I make $20,000 a month. Give me every last nickel out of my house. A lot of the people that lost their homes were in their shoes. And I can tell you stories. So that's the bad borrower that put themselves in a bad spot. I can tell you stories of bad brokers that did really shitty things, that basically put people into loans where there was no option. They were going to get foreclosed on one way or the other, even if the market didn't take a tank. So it's just, you can't put it on the market, and you can't say, well, did you say that to people in 2008? Kind of like we don't pass laws here, Jeb, to just, we have an issue today. There's personal accountability. You have to make a decision. We show up here every week, Jeb, and say, do your research, determine the facts, and make the best decision for you and your family.
No, exactly. And I'll go on to say, yeah, of course there are people that regret buying, right? I mean, there are people out there, but I will tell you, in the conversations when I'm sitting down with sellers, the conversation is always, hey, I didn't know how I was going to do this when I first bought it. I talk to a lot of older people that have owned their home very long periods of time, and they always tell me, because I always ask, hey, how did you, what did you pay for the house? How did that payment, what was that payment like back then? And most of them are like, I had no idea how I was going to make that payment, but I made it, and I'm sure glad I did. And now I look back and wish that I would have done this several times. It's the stories over and over again. And it's not here to tell you that that's what you need to do. It's just to say, real estate's a long-term game. There's a lot of house hacking. There's a lot of videos showing you, hey, this is short-term. This is how you make money in real estate. Yeah, you can do some of those things and make money, but the real money is made in fixing your housing cost while rents are increasing, paying down the principal, leveraging your money, and growing an asset over time. That's the benefit of real estate.
Well,
anyway,
Jeb,
Josh,
just sort of on the same subject here, Drew follows up. He's had several comments.
I love Drew's comment. One of them,
a $250,000 mortgage right now amortizes over 30 years to be $500,000. Okay. What does $2,500 rent today amortize to over the next 30 years with 3% rent inflation? You're not protected by not buying a house. And this is not something that's crazy or magical. We go back in time.
That I loved, by the way.
When I started doing loans in the 90s at 8.5%, 9%, you would look at the truth in lending, and the total payments over the life of the loan were generally triple. You would triple whatever you were paying for the house. And those are the same people that you're looking at now going, oh, these sellers don't know how good they had it. They were looking at the same math as you, only worse, but you're not protected as a renter. So it's just, I'm not by any stretch of the imagination saying everyone should buy, that buying is easy, that buying is possible, or that the market currently as it sits is good. It's not. It sucks. It's hard. but being a renter doesn't save you. You're not hiding. You're not protected as a renter. You're going to be subject to the same things. Only that $500,000 is going to pay your landlord's mortgage.
There you go. The comment that I did like from Drew was this one: newer engineer, and I can't afford a home. That's not what I like, but he followed it up with yet. Yet. I love the yet part. I can't do it now, but I will be able to, in theory, is what he's saying. It's what I use with my kids. Maybe it's a female. I don't know. Drew could go either way. But either way, yet. When my kids say they can't do something, I always say yet, because don't get in the mindset that you can't do something. Get in the mindset of figuring out how you can do it. Somehow, Josh, we've turned into some sort of motivational podcast here.
I like it.
Let's transition. Yeah, there's the negativity just never stops. I swear. It's you give people an hour of your time. They're not happy with the hour that you give them. They want more time, but then they want to bitch and argue with you while you're here providing them with the information that many of them want. It's truly an amazing thing, the internet. All right, let's see here. Let's just go with this. I don't even know what it is. But Carlos says, been trying to buy a house for almost a year, made multiple offers, some 60,000 over ask, and I get outbid every time by others who make an all cash offer, waive inspection appraisal, New York, Virginia. So earlier in the show, we mentioned the Northeast. Virginia is not really the Northeast, but it's heading up the coast of the Northeast. Those markets seem to be, based on what I'm reading, based on comments from viewers, the most competitive markets out there. Southern California is still competitive, but I will say it is slowing. I can tell open houses are slower. Number of offers coming in on properties, slower. If properties are priced correctly, they're still selling. It's just not what it was 6 months ago, 8 months ago, a year, 2 years ago. But the Northeast seems to be crazy. And so that type of market is driven by supply and demand, just like any other market. There's a lack of supply up in that area. Therefore, demand exceeds supply, prices go up, it's competitive, all of the things that we've talked about. Carlos
followed up. New York VA loan. So
there you go.
Zero down, most likely. Carlos, you can confirm if that's true or not. It definitely is tougher when you have these buyers.
Absolutely.
Like Jeb, you had the one this week. What, you ended up with a couple 2-3 cash offers. Is there anything
4.
a VA buyer?
6 offers, 4 were cash.
What is there anything a VA buyer could do in that instance?
In this case, probably not, because the home sold for $100,000 over the asking price. And we're talking a 1.35 list price. We sold for $1,450,000. So what's the math on that? That's 8%, 7% over the asking price. Pretty good amount. Could a VA buyer compete with that? Probably not. Now, if the property had sold at the asking price, I'm not afraid of a VA offer. That's the thing, is it comes down to listing agents. Oftentimes I'll get a seller calling me, hey, my client's a cash offer. Okay. And why? Like that's not an incentive to my client. In most cases, I'm not making the decision, but my client and I, we talk about offers and the potential, and the cash isn't an incentive unless they need a super quick close or unless we're worried about an appraisal or something else. So if a property sells at the asking price and we've priced it correctly, then in my head, I'm going, a VA loan could be okay. And at the end of the day, I want competent, somebody that communicates well, that, professional on the other side of the transaction. So I'm going to convey that to the seller. Hey, listen, this is a VA buyer, a veteran, served our country. These are the benefits of the offer. These are the downsides. This is what you're competing against. At the end of the day, it's your decision. And let them decide. Ultimately, I can't decide for them, but I'm not afraid of a VA offer. Some people are, truly, and that's a problem. And it's typically comes down to a lack of understanding with the offer. So maybe if your agent's not doing this already, if maybe they're not privy, your mortgage professional needs to be reaching out with these offers and conveying how well qualified you are, that your financing is not an issue, that you are good to go, how important, it is for you and your family, and try to sell it in some way. But it's a lack of knowledge is really what it is. Josh, we are at 59 minutes. Time just flies when you have a good time. Let's see. What do we got? Any good questions here?
Well, we got a good comment here. Ansley Lindstrom, first-time buyer in Virginia, offer just
People
got
are so
accepted.
dumb. People are so dumb.
$525,000 townhome. Anxiously awaiting for the appraisal to come back tomorrow because they're a little bit over listing price in that Northeast. Does Virginia qualify as a Northeast, or are they a little too far south to be Northeast?
What was that? Virginia? What
Yeah.
was the state? Yeah, you
Virginia.
can't. And they're definitely not Northeast. They're not the South. Sometimes they'll claim they're the South, but right there, Mason-Dixon line, you either are or you're not. And I don't know. Let's see here. Carlos followed up, very thankful. So you are welcome on that. Guys, if you want to get more hate comments, if you like being yelled at and like being told you're an idiot, just make a video where you tell people the market's not crashing. It is the greatest spectacle of, I can't say knowledge because there's very little knowledge going into it. It's a circus. It's a circus of people commenting, and it can be amusing to read. And it's funny. It's very, very funny. So Virginia's the Mid-Atlantic is what we're calling that, which fair enough. It's Mid-Atlantic. So, but we don't refer to anything else Atlantic. We don't go, that's the South Atlantic. That's the North Atlantic. So why do they become the Mid-Atlantic? Just because they're in the middle of the state and they're on the Atlantic Ocean, Josh?
Yep. Jeb, let's follow up on the flight simulation experience. Comes back and says, I can afford a home, but I choose to rent and been renting for 18 years, which has allowed me to save 70% of my income.
That's awesome.
If I bought, that wouldn't have happened. I don't know that that's true. I don't know that it matters. You were disciplined.
Exactly. Most people are
disciplined and saved and skilled at investing. The finish line is all that matters. There's multiple ways to get there. Home ownership is not the only way to get there. Just realize if you're choosing not to become a homeowner, you need to do what flight simulation experience did: be disciplined, save, and successfully invest.
Listen,
otherwise, you're going to end up in a world of hurt if you don't do one of those two things.
I told you a story. Somebody said the other day, these guys never tell anybody not to buy. Tell the story a couple of weeks. In fact, she reached out to me after the show and said, thank you for telling my story on there. It affirms basically what I was thinking. So I told the story. I'm going to tell it again. A professor at USC and her husband's an attorney, younger couple. They have small kids. They live in Beverly Hills area. And she wants to become a homeowner. They make good money. 350,000 or so combined, pretty good money in early stages of career and that sort of thing with regards to the attorney. So I think income can probably go up over time. She's potential partner in a business that might go public. I mean, so there's other potential opportunities here, but she reached out to me. Her rent was $3,500 a month. And currently her and her husband are saving $7,000 per month by renting. And I said, okay, but what happens as your rent increases? She goes, here's the thing. My rent's not going to increase because we're in some sort of subsidized housing in Beverly Hills. And she goes, it does increase, but it's like $100. And I'm like, why would you buy? You're putting in, unless you just want another house, you need something in your life. I go, your kids are going to be in college in the next 7-8 years. Your needs are going to change. And she said basically $7-8 a month is what they were saving, but upwards of $100,000 a year is what it came down to. And it would continue to increase. I'm like, as long as you're doing something with that money and putting it in a place where it will grow and you're fixing your housing costs now to some regard, it's okay that you're okay to be in a renter position. But most people aren't in that position. And most people aren't putting away $7,000, $8,000, $10,000 a month in their savings. They're spending $7,000, $8,000, $10,000 that they would be spending somewhere else on some other deal. So it's all about discipline. It's all about doing what's right for you. But what I would ask flight simulation is, why do you show up here on the educated home buyer if you don't plan on being a home buyer? Real question. I just want to know. So anyway.
Jeb, we do have another good question. I know we are going to be out of here at some point here in the near future. Padre de la Verde says, how would you use $1.2 million in equity? My other owns 3 homes, free and clear, wants to expand her portfolio. With the higher rate, she's wondering if she should 1031 exchange, sell and pay capital gains. I wouldn't sell and pay capital gains. So let me lead off with this, Jeb, and then you go whatever direction that thought takes you. Mm-hmm. The greatest thing you can ever leave to your heirs is highly appreciated real estate. because it gets reassessed upon your death at the current value, and they can sell it without having to pay a bunch of taxes on it. If you have a really large estate, that gets complicated. But for most of us who don't have a 10, 12, 15, $20 million estate, the best thing you could ever leave is real estate. So if she's able to 1031, keep it all, not pay the taxes, push it on until sometimes she leaves this earth and leaves it to you or other heirs, that's the greatest thing that she could leave behind. So the question of how to reallocate it, what's wrong with what we have right now? What are we trying to reallocate into? We would like to take 3 single families into a small apartment building. Those are the questions that I have, but I wouldn't sell and pay the taxes. And I would definitely stay in real estate because it has advantages versus other assets when you leave them to your heirs.
Yeah, no, absolutely. And you can't 1030. Well, I guess you could 1031 part of it, depending on if she lives in one and whatever. So the 2 that she's renting out, she could 1031. But I would go back and kind of, double down on what Josh said. There's the potential to maybe do a home equity line, pull some cash out, and use that to leverage another piece of real estate, potentially add more to the portfolio, if you will, if that's the goal. But what is the ultimate goal here? She's at $1.2 million in equity. Is she trying to generate more cash? Is she trying, what is she trying to accomplish? It's not an easy answer. But like Josh said, leaving that to you guys, whether you're the only child or you have siblings or whatever, or to your kids or what, I mean, that's how generations become, financially well off long-term. And so, it all comes down to each person's goals and what they're trying to accomplish. So that's where I would focus my time. So Josh, been on here just over an hour. If you haven't done so already, hit the thumbs up, subscribe to the channel. Tim, you're going to email me. I'm going to send you a shirt. If you found any value tonight, rate us and review us, guys. It takes a minute to press a 5-star on a Spotify, on Apple. Yeah, I use an Apple now. I should know that. An Apple phone. Don't go to Google because they're canceling podcasts. Imagine that. But anyway,
They're
Josh,
rolling it into YouTube Music. They want everyone to be a YouTuber and a YouTube user so they can have 1.6 million cash offers on their homes.
there you go. So Josh, anything you want to add tonight before we head out? Any more motivational speak?
We've got all the motivational speak, but just really, if you're here and you're watching and you want to become a homeowner, you got to keep positive, even if your realistic nature tells you, hey, it's not realistic today. Just keep watching, keep educating yourself, keep saving and investing in the meantime, so that if and when that becomes a reality in the future, you're in a position to do it. You don't have to do it today. Especially, we get a lot of young people on the show, Jeb, 25, 22, 28, and they're like, oh God, I'm never going to be able to do this. The world is going to change a lot in the next 30 years. You're going to change a lot, and you're going to have opportunities to do anything you want. If that is truly what you want, you commit to it. Is that motivational enough, Jeb?
Good stuff. All right, guys, until next week, sayonara.